Let's move forward. Masterclass access to global markets via Irish funds. Brian Kelliher, Partner, Asset Management and Investment Funds, Dillon, Eustace. Dillon Eustace is one of Ireland's leading law firms focusing on asset management and investment funds, banking and capital markets, corporate and M&A, employment, financial services, insurance, litigation and dispute resolution, real estate and taxation. Can we have Mr. Brian on stage? Over to you, sir.
Good afternoon, everyone, and delighted to be here today with you all. And I hope over the next 20 minutes to give you some insight into, I suppose, raising capital from global investors using Ireland as a domicile. Sorry. So while we're waiting for the slides to be corrected, I suppose just to give you an introduction, historically, my experience in dealing with Indian manager has been on the public asset side, where you have a select number of asset managers on the public asset side have used Ireland as a domicile to raise capital from global investors. So the purpose of today is to give you a flavour of what we've seen, but also to give you a flavour of the opportunities in the private asset side. So over the next 20 minutes, I propose to set out why Ireland is a domicile. There's obviously a lot of fund domiciles that can be used for Indian managers, not least those closer to home. I want to give you a flavour of the legal structures available in Ireland and the various regulatory structures. I also want to give you an overview of what we're seeing in terms of maybe US investors accessing European funds. And also then to just give you a slight oversight of some of the regulatory structures and the rules that apply to them and how they're used. And then finally, I just want to talk about the tax advantages of using Ireland and I suppose the time frame for establishing a fund in Ireland. So why Ireland is a fund domicile? So this is a question I'm asked all the time when I visit India. And I suppose there are a number of answers to that. Probably the primary answer is the internationally recognized jurisdiction. And that's really important for global investors. Also, it's a member of the OECD, it's the member of the EU, the Eurozone, IOSCO, and FATF. And of course, it's the membership of the EU that gives Ireland access to the other 26 countries in the EU. So that is the advantage of using Ireland as a domicile. It's the access to the remaining countries and states of the EU. So the other advantages are it's an English-speaking, it's the only English-speaking civil law country or common law country in the EU. It's a tax-efficient regime, complying with OECD requirements. And of course, there's a tax treaty network with over 70 countries worldwide. And of course, there is a tax treaty with India, and a very beneficial one, in which there's no advantage in the capital gains on the I suppose the equity side, but there are reduced withholding taxes on all other assets in the context of capital gains, and there's also reduced withholding taxes on dividend income and interest income. So there's over 430 financial services companies operating in Ireland, and including 20 of the top 25 operating companies in the world. And they range in activities from asset management to the administration services to aviation finance. Ireland has been a funds domicile for over 30 years, so it has 30 years experience, and with that comes expertise by the service providers and by the persons within the industry, not just servicing Irish domicile funds, but Ireland also is a domicile which services other domiciles such as Cayman, BVI, Bermuda, some of the Channel Islands. So there's lots of expertise both on the public asset side and on the private asset side. And in total, there's about 17,000 people working in the industry in Ireland who are providing support services to the funds industry. You can see from the slide, Ireland's the leading domicile for servicing of hedge fund, global hedge funds, with about 40% of assets serviced from Ireland. These are assets of global hedge funds being serviced in Ireland. And similarly, Ireland is a leading domicile for ETFs. So the leading domicile for ETFs is the US, and followed by Europe. And Ireland represents the majority of the assets in European domicile funds, with over near 70% of the assets. And finally, but not least, Ireland is a hub for cross-border distribution into the EU, with Irish funds being sold in about 90 countries. That's across Europe, the Americas, Asia Pacific, Africa, and the Middle East. So the next slide just gives you a flavour of the number of funds, the assets under management, and you can see on the right-hand side it focuses on the Irish domicile funds, and there's about 3.7 trillion in assets under management, and the number of funds is in excess of 8,000 Irish domicile funds. I think as of October last, it was 8,000, in excess of 8,700. On the left-hand side of the chart, what you're seeing is a combined figures taking into account the funds that are the non-Irish domicile funds that are serviced from Ireland. So you can see total assets serviced from Ireland are 5.4 trillion, and the total number of funds actually serviced are over 14,495. And the next slide just gives you a sense of the level of growth in the assets under administration and in Irish domicile funds. And you can see there's a gradual increase, but also there's, I suppose you can see these data as of October of last year. So the structures available in Ireland are probably no different to any other jurisdiction. There's corporate structures and there's non-corporate structures. The most popular of the corporate structures are the ICAV structure. It's an Irish collective asset management vehicle, and certainly most of the asset managers who've established, the Indian asset managers who've established funds in Ireland have utilised the ICAV. The non-corporate structures are the unit trust structure, of which I'm aware of one Indian asset manager who utilised that structure for one of their products, and that was mainly because of their own organisational requirements. There's a common contractual fund, which is a contractual type fund, and there's the ILP. So in terms of the organisational structures, I'm sure it's no different to what you see in other jurisdictions. With a corporate structure, you have a board of directors, and that board of directors is ultimately responsible for the running of the fund, and they generally appoint a management company, whether that be on a Eustace management company or an AIFM. And in Ireland, there are lots of companies that provide third-party management services, and to date, the Indian managers who have utilised Ireland have utilised those third-party management companies, who in turn, you can see from the chart, they delegate the performance of a number of functions, and they delegate investment management to the Indian investment manager, administration to an Irish administrator, and distribution to, generally they delegate that function to the Indian manager and affiliate in the group, who in turn will appoint, in due course, sub-distributors in particular jurisdictions they're focusing in. And of course, those jurisdictions could be in Europe, but they also could be outside Europe. And similarly, the ILP structure is very similar, but I suppose what I would point out, you can see there's an AIFM in the structure. So you have a GP who generally appoints an AIFM, and an AIFM in turn delegates the functions. The AIFM could constitute the GP, but generally because the unlimited liability at the GP level, the AIFM tends to be a different entity in order to avoid contagion. So moving along, I want to turn to the regulatory structures. So Most Indian managers are familiar with the Eustace structure, which is a European structure and not unique to Ireland. So the idea behind the Eustace structure is once it's authorised in one member state in the EU, it can be sold cross-border to retail and professional investors in the EU without having to seek separate authorization in the host member state. So it's really popular. It's, as we'll see, it's a global brand. It's very similar to the 1940 fund in the US. It's very well known. The other structures on the chart are AIFs. These are non-UCITS, and they're essentially alternative investment funds, but they can be used for investing in private assets, but equally they could be used for the purposes of investing in well, two of them can of the three can be used for investing in public assets. So the RAIF is an Irish structure. It can be sold to retail investors, but it's not generally used, or broadly used, because it cannot be passported within the EU, which means it cannot be marketed openly cross-border within the EU to retail investors. The most popular and common used AIF in Ireland is the QUAIF. So QUAIF is an AIF that's domiciled in Ireland, which can be sold only to qualifying investors. But what the big advantage of the QUAIF is that, similar to a UCITS, the AIFM can market the fund in the EU to professional investors cross-border without having to obtain authorization in each EU member state. So it's very popular, not just for giving exposure to global investors of private assets, but also in terms of public assets for various reasons. It might be the case that the strategy doesn't fit in within a UCITS structure. It may be that the assets are not as liquid as maybe some of the assets within a UCITS structure. The other regulatory structure in the chart is an LTIF. Now, the LTIF is a European structure, so it's very similar to UCITS in the sense that it originates from European legislation. What it stands for is a European long-term investment fund. So this structure can only invest in private assets. But the real big advantage of this structure is that it can be sold cross-border to retail and professional investors within the EU. So this is a structure that gives private asset exposure to retail investors. So the next slide is focusing on US investors. US investors, similar to other offshore funds, they do invest in Irish funds, and essentially what you're seeing is, I suppose, marketing to both US tax-exempt and US taxable investors, and falling, I suppose, within the exemptions within the US local laws, being the SEC Act and the 1940 Act. I think the slides have gone. Oh, here we go. And I'm sure what we're seeing is that, where the US taxable investors invest in an Irish structure, they're looking for that structure to tick the box to be treated as a partnership for US federal tax purposes. And generally, from a tax perspective, there is no issue with US tax-exempt investors investing in that structure, provided the Irish fund is not borrowing or leveraged. So where the Irish fund does tick the box to be treated as a partnership, and US tax-exempt investors are interested in the structure, generally they will avoid that structure and they would come in through a feeder route that would be a corporate blocker, which just generally means that structure ticks the box to be treated as a corporate for tax purposes, US federal tax purposes. So essentially what you have, if necessary, is you have a master feeder with the master attracting the US taxable investors and the feeder attracting the US tax-exempt investors and the non-US investors. So the regulatory regime applicable, I just want to talk about the structures that we saw on the chart earlier. So the UCITS, I'm not going to dwell on this too much because the UCITS essentially is a public asset structure. Although this is the structure that's most used by Indian asset managers to date, purely to give exposure to Indian public assets. But I suppose the key characteristic of a UCITS is that it's open-ended. It gives investors liquidity in that they can redeem frequently, and the requirement is at least once every 2 weeks. But most UCITS in practice give shareholders the option to redeem on a daily basis. And because it can be sold to retail investors, what you see is very diversified requirements, concentration rules that need to be adhered to, and more of a focus by the central bank on this type of product, taking into account the emphasis on investor protection. So some asset managers who have set up in Ireland to give exposure to Indian public markets have found those diversification requirements too stringent, mainly because of the concentrated investment strategy that the Indian manager has in their own portfolio. And sometimes they turn to the quay structure that I mentioned earlier in the chart. So this is, again, just to remind you, the AIF that can be sold cross-border within the EU to professional investors. So as I said, there was at least 2 that I'm aware of that established quays in Ireland, as I said, for the purposes of giving exposure to the public markets. But the quaif is probably used more for private assets, whether that be for real estate exposure, private credit, private equity, and it also for maybe real assets. So it's quite broad in its base. The thing to realise is that there's 100,000 minimum subscription for that, and as I mentioned, this qualifying investor means it can only be sold to professional investors within the EU. So another advantage, as listed on the slides, is the speed to market, and that speed to market arises because the central bank relies on the service providers and the legal counsel in Ireland to certify that all the regulatory disclosures are included, rather than the central bank reviewing documentation and clearing that documentation before full authorization can be made. So one of the possibilities, now I've heard, while I've been in India this week, I've heard how much that there is no shortage of capital in the private assets market, both domestically and from foreign investors. But an underlying theme here is that certainly Indian funds, Gift City funds, Mauritius funds, they don't have access to the EU markets. So there's no automatic access to those markets. What there is the right to approach each individual member state individually and to seek to market the shares of your fund, the offshore fund, via the national private placement regime in that member state. Most EU member states have closed that and have very onerous requirements. So in reality, there are about 2 or 3 member states that would facilitate marketing in their jurisdiction. So one of the solutions where Indian asset managers want to give global investors exposure is to use the quay structure. And the quay could invest directly into India in the private assets itself. So just like a UCITS structure, it would be managed by the Indian investment manager. The alternative is for the quay to invest indirectly in India via an AIF that's managed by the Indian investment manager, whether that's in India, Gift City, Mauritius. And so there's a principle within the EU regulatory regime, and that is if you're an EU AIF and you're managed by an EU AIFM, you have the right to passport to sell cross-border to professional investors. The exception is if you're a feeder fund and the underlying fund is in a non-EU jurisdiction or managed by a non-EU manager. So the solution around that is the quaif invests 85% of its assets in the underlying fund and the balance directly in the private assets, either directly or through co-investment, or could invest in a second AIF or liquid assets. So it's a way of achieving another category or another channel of raising capital by able to accessing the institutional investors within the EU and the wholesale market, be your family offices, wealth manager offices, etc. And I suppose finally, just in terms of the why establish an Irish QUAIF, I suppose, as mentioned, the national private placement regime has been tightened by the various member states. You have the benefit of the passport so that you can sell to professional investors throughout the EU. The AIFM directive, which is the regulatory regime, gives you the investor protection, transparency in governments. And I suppose one of the final points I'd mention is that there are certain allocators within the European Union who, because of various reasons, whether it be political or their own shareholders, tend to steer away from certain financial centres or fund centres. And so there is an element of the actual fund centre, the fund domicile, being reputable and acceptable to these allocators. So the final regulatory structure I want to refer to is the ELTIF. So as I mentioned to you, it was a European structure. So it's focusing on long-term assets and in the real economy. But the real benefit of this structure is it can be sold to retail investors. It similarly can be sold to professional investors. You can see there's a minimum of 55% has to be invested in private assets. Of course, that can be extended to 100%, but it gives you the flexibility to have certain liquid assets in the product. So you can have up to 45% of the assets in liquid assets. And you may say, well, why would you have liquid assets in a private asset product? Well, if you're trying to attract retail investors and you want to give them the option to redeem during the life of the fund, there's a possibility to do that by having a certain pocket of liquid assets available to them. Of course, what that does mean is that depending on the number of redemptions being requested, you have to limit those numbers based on the amount of liquid assets in the portfolio. So this slide just lists the various diversification requirements and concentration rules. But the important point is these requirements only apply if the fund is being sold to retail investors. If the fund is being sold to professional investors, all these requirements fall away. And similarly, the borrowing limits, they might appear quite small, 50% of NAV for a fund being sold to retail investors, and 100% being sold to professional investors, but that excludes borrowing, which is covered by committed capital. So finally, just to talk about the tax. So irrespective of what type of structure you set up in Ireland, whether it's a Eustace, a QUAIF, or an ELTIF, in the context of a non-Irish resident investor, they suffer no tax on their investments. There's no withholding tax on any payments made by the fund to the non-Irish resident investor. And there's further no indirect taxes. There's no transfer taxes, no stamp duty, and there's no VAT imposed on management services, administration, depository services. And as mentioned earlier, there's the withholding tax. I mean, generally speaking, Irish funds, just like any other jurisdiction, will suffer withholding tax in the country of issue of their investments. But there is a strong tax treaty with India, and there's benefits, as I mentioned, on capital gains across all asset classes except equities, and there's reduced withholding taxes on dividend income and interest income. So just finally, this just gives you a synopsis or a snapshot of what's involved. So irrespective of the type of fund that's been set up in Ireland, because it's a regulated structure, you need to have the investment manager approved by the central bank. That's just to prove to act as investment manager of an Irish scheme. Doesn't mean they're regulated, doesn't mean they're supervised. It's just a process that the central bank needs to be satisfied that they're regulated, have sufficient financial resources, they have the experience in managing other funds. So this process can take 4 to 6 weeks. The reason being is because the central bank will reach out to SEBI, and also the manager selected by the Indian asset manager, this is the manager in Ireland that provides third-party management services, they will need to certify to the central bank that they've carried out due diligence on the investment manager and that they're satisfied with it, and this can take some time. So once in the context of a QUAIF, once the central bank has signed off on the investment manager approval, and once the directors of the fund have been approved, assuming it's a corporate structure, it's open to formally apply for authorization to the central bank. So the timing can be quite quick. Generally speaking, you'd be talking about, in general, around 2 months from the time the investment manager selects all the service providers. In the context of a Eustace or any other AIF that's sold to retail investors, the timing is a little bit longer, and the reason being is the central bank will want to review the prospectus and the offering document because of the retail element, the retail investor element, and because of investor protection element. So we're talking in that context about 4 months to 5 months from the time the fund, the Indian asset manager, has signed off on all of the service providers to be appointed. And of course, once the fund is authorised, then at that stage the FPI licence is applied for, assuming we're investing in public markets. And of course the Section 9A approval is also sought. Now, my experience with the Section 9A approval is that it's not always applied for in all cases. In some cases, particularly where there's no benefit under the Double Taxation Treaty, views are taken that perhaps it's not required before launch, and whether they do so afterwards would depend on the level of dividend income in the fund. So I hope that gives you a general overview of the Irish market and the Irish fund domicile, and it's some way of help to you. So I'm going to conclude there, but ask you, if you have any questions, to please feel free to ask. Thanks.
Any questions? You all are very thorough.
Thank you.
I request you to please stay back on stage, and now I request Richie Sanchetti to please come on stage to felicitate Brian. Thank you so much. You all may please take your seats.